This week will be critically important for markets, and we'll break it down in this video. A matter of fact, Tom Lee recently came out and reaffirmed his 50% rally expectations for the Russell 2000, and this week will be a test to that. If things do not go good this week, it'll be very hard to get any kind of rally even close to 50% in small caps. But if this week does go as markets are expecting it will, then a 50% rally for small caps is definitely not out of the question. But before we get into all of that information, let me know down below in the comment section if you would buy an ETF with just Tom Lee's granny shots in it. Tom Lee shared this post on his X account that he was tagged in and said, "We need a Granny Shots ETF." In fact, a potential Granny Shots ETF year to date would be up 13.28% versus the S&P 500, up 2% year to date, and it would have beat the S&P 500 by about 110% since its inception. But first up this week, and why it's so important, really comes down to Friday. Friday, we are going to have core PCE month over month, core PCE year over year, personal income month over month, personal spending month over month, Chicago PMIs, and Fed speakers. According to the chief economist at Bloomberg, if core PCE comes in line with expectations month over month at 0.2%, that will be the lowest core PCE number that we have seen so far in 2024. That would mean decelerating core PCE and likely a greater chance of rate cuts coming this year. That would enable Tom Lee's prediction of a 50% rally in small caps to actually be feasible. But if core PCE comes in on the hot side, markets are going to be in trouble. The next Fed meeting is on June 12th. In fact, we will get a CPI report around that same time. None of these inflation numbers, whether they are good or bad, are likely going to change what the Fed does on June 12th. But it will have a big impact to what happens on the following Fed meeting coming July 31st. 2024. Current expectations for July 31st are a 10% chance of a cut and almost a 90% chance of a continued pause. There is almost a 1% chance that we actually get a rate hike by July 31st. So the odds are kind of all over the place, but general consensus is the Fed is not going to raise rates or cut rates coming July 31st. But if we get a good PCE number this Friday, if we get a good CPI number coming before this next upcoming Fed meeting, and then better numbers for July, because keep in mind, July 31st is the end of the month, so we'll get another inflation number for PCE, PPI, as well as CPI coming before July 31st. Then that does open you up for the first cut coming July 31st. It's generally considered three good readings or bad readings of any given data point can mark a trend. We have already gotten one lower than expected CPI report. If we're going to get another one coming in early June, and then maybe another one in early July, that could definitely set you up for that first cut, July 31st. At the same time, if the economy does start to weaken further, then that's going to be more pressure on the Fed to start cutting rates. Because let's be honest, there has only ever been one president that has won a re-election if there was a recession within 2 years of that election. Meaning, if we were to theoretically start to see the economy getting worse and worse and worse heading into November, then the current administration's probably not going to get reelected, just based on a historical precedence. In fact, the only president to have ever won a reelection, if there was a recession within 2 years before that reelection, was William Taft back in 1913. And yes, there has been 6 presidents that have tried since, and all of them have lost. So that could put more political pressure on the Fed to start reducing the restrictiveness in this economy. In fact, BlackRock's chief of market strategy just came out recently and said we actually need cuts from the Fed to get inflation down. And that's because shelter really continues to be the only reason inflation is still coming in hot. If you look at harmonized core PCE, and core CPI on a harmonized basis, this is what they use over in Europe, then you are sitting at under 2%, both core PCE and core CPI. And let's all be honest, I think the Fed knows that shelter is just one of those things that is going to take a long time to come down in the current way that we report the data. I mean, if you look at market rents, that's what you really want to watch for. If that starts to rise and show inflationary pressures, then we're going to be in a bit of a problem from the Fed. But until then, I think it's only a matter of time before the Fed cuts rates. With everyone starting to say there's no cuts coming in 2024, I'm getting more bullish on cuts coming in 2024 as a contrarian by nature. And this will definitely help out small cap stocks, as recently people are starting to call for no cuts in 2024. The markets start to price that in. And then as you do start to get cuts in 2024, that can mean larger upside from current levels. Not to mention, earnings growth will start to reaccelerate again for small caps in the third and fourth quarter of this year. Some investors, though, have started to point out that the S&P 500 moving higher as market breadth is moving lower can be a negative sign for stocks. Now you only have about 46% of stocks in the S&P 500 that are above their 50-day moving average as markets are hitting all-time highs. The percent of stocks above their 50-day moving average has actually been falling. That could be a negative sign for the near term, but I do think the rally we seen on Friday is an even better sign of good things to come in the short term. I mean, the Russell was up over 1%, the NASDAQ and the S&P with similar returns on Friday, heading into a long weekend with even today markets being closed. I think looks pretty good. There's this saying called down Friday, down Monday. The same is true to the other side, right? I'm sure you've heard that side of it, but up Friday, up Monday. They tend to correlate, but because if you're going to go into super bullish positions on Friday, then you're not expecting a bad Monday, presumably. But it is possible you get some anticipatory selling midweek before you get that PCE number, CPI is so programmed in the brain, PCE number that comes out on Friday. And that's something to be on the lookout for. If you look at all stocks on our markets, not just the S&P 500, 51.3% of those stocks are above their 50-day moving average, with a 3% rise on Friday. So the broader markets look a little bit better than the S&P 500 right now, which is another good sign for small cap stocks. Even though breadth has been fading here, you were at about 61% of stocks above their 50-day moving average back on May 20th. And you did hit a new all-time high on Thursday. Before that, over 1% sell-off from the high of the day on Thursday. So yes, breadth has been getting worse as the markets have been holding up. That is true. CNN's Fear and Greed Index is sitting at 53, which is neutral today. Last week, it was at 64, which was in greed territory. Market momentum is greed. Stock price strength is fear. Stock price breadth is neutral. Put and call options is neutral. Market volatility is neutral. Safe haven demand is greed. And junk bond demand is in fear. On that note, your latest AI investor sentiment survey came in showing bulls went up almost 6% to 47.0%. Neutral investors dropped the most, almost 9%, down to 26.6%. And bearish investors actually increased about 3.3% to 26.3%. It's very rare to see bulls and bears go up in any given week and neutral to actually get compressed. Normally it's, the amount of bulls will go up, neutral investors will go up, and bears will fall. Or it's bears will rise, bullish investors will fall, and neutral will rise. Not bulls rose, bears rose, but neutral investors declined. And that's pretty abnormal. StockTwit's sentiment for the S&P 500 is bearish today at 32. Yesterday, it was bearish at 37. So that's pretty interesting. Again, from a contrarian standpoint, if a lot of people are bearish heading into this week, it's probably going to be a good week. Futures were open for a little period of time today, and the Dow was up 0.15%, S&P up 0.23%, and the Nasdaq was up 0.4%, whereas oil was up about 1%, and 10-year Treasury yields were down about 1 basis point. Besides just Friday, we will have other data as well coming out. Nothing for tomorrow or today, which, you know, that's pretty obvious. Tomorrow, you will have S&P Case-Shiller home price month over month and year over year. That's highlighted here in dark, bold, and black, seen as kind of a medium volatility catalyst. They don't tend to move the markets whenever S&P Case-Shiller data comes out, but it can. You do have Fed Kashkari that speaks tomorrow around 9 a.m., as well as consumer confidence that comes out about 10 o'clock in the morning tomorrow, which definitely will be important. You will get Dallas Fed Manufacturing Index at about 10:30 a.m., expecting that to come in very negative. Also, you will get the money supply data, expecting that's going to be over $21 trillion. A 5-year bond auction and some shorter duration bond auctions spread throughout the morning tomorrow. Fed Cook and Fed Daily both speak at about 1:05 p.m. Eastern Standard Time tomorrow. On Wednesday, lots of data coming out from Europe, including the inflation rate year over year, the harmonized rate from Germany, Tuesday morning at 8 o'clock in the morning. You will get Richmond Fed Manufacturing Index, expecting that to be very negative, Richmond Fed Manufacturing Shipments Index, and Richmond Fed Services Index. That services number will likely be the most important. At the same time, you will get Dallas Fed Services Index. Both of those numbers expected to be about -10, so not great for the service sector of the economies around Dallas and the Richmond area. You will get a 7-year bond auction, which can be important for markets. Fed Williams, this speaks around 1 p.m., and Fed Bostic, that speaks around 7 p.m. Eastern Standard Time on Wednesday. On Thursday, you're going to get GDP growth rate quarter over quarter, the second estimate for Q1. The last number we had was 3.4%. We're expecting this could fall to about 1.4%. So to some degree, the lower the better for stocks. But on the other hand, if it comes in really low, then that's a bad thing for the economy. So it's kind of a trade-off between the economy not doing too good and not doing too bad. So you likely want a number that meets expectations, maybe comes in a little bit higher than 1.4%. You will get corporate profits quarter over quarter, goods trades balance, and initial jobless claims. And people are watching this like a hawk right now on a week-by-week basis to see if we get more weakness in the labor market. Inevitably, weakness in the labor market and or the economy will turn into a bad thing for the markets. And the longer this stays good, the better. If you hear anyone say it's good news for stocks, the economy is getting worse, or the labor market's getting worse, I would personally just click off the video or clip, whatever you're watching at that moment, because that's never going to be a good thing for stocks, even if that means the Fed is able to cut rates sooner. You will get PCE prices quarter over quarter, second estimate as well, and real consumer spending, the second estimate for Q1. All of that data coming out at 8:30 in the morning on Thursday. Pending home sales month over month and year over year that come out at 10 o'clock in the morning on Thursday. Fed Williams, this speaks around noon. Fed Logan, this speaks at 5 p.m. And that is it for Thursday. And then we already went over Friday. At least your big data will be core PCE month over month, expecting that number around 0.2%. A 0.3 or higher is going to be bad news. Personal income month over month expected around 0.3%. As long as we meet expectations or come in, lower there, probably going to be good as well. Personal spending, I think, is a pretty important one. That is expected to actually hit 0.4%. Last month, it was 0.8% on a month-over-month basis. So markets will probably like a lower number there, but still, that's one of those things. You don't want to see a super low number. That's going to be bad news. Chicago PMI is expected at 39. Last month, this came in at 37.9. So stronger economic data. Again, I think is good news for markets. It's good news for corporate profits, but maybe bad news for the Fed. We're done. That is actually a lot that we have for this week. Just some of your big data on Friday, but a lot of smaller pieces of data, lots of Fed speakers, and a couple important bond auctions scattered throughout this upcoming week. Basically, every single day of this week, you're going to have some moderately important data coming out. So I do think this week is critically important for markets. Whether or not we will see a broadening out of our markets, a fall from here, which, would be bad news. Maybe some people are expecting that. Or if we're going to see a real outperformance of your everyday stocks, your small caps, and your interest rate sensitive stocks. All of that could be decided in this upcoming week. For those of you guys that are bearish, you want to be watching this 50-day moving average. As JP Morgan has recently stated, if you fall under this 50-day moving average, that's where you get more likely to continue to fall from there. JP Morgan recently came out and said, if we fall under that 50-day moving average, that's really your level to potentially go out and hedge your portfolio. Until you fall under that 50-day moving average, things still look pretty good. And if you fall under that, then you're looking at new lows more than likely for 2024. And keep in mind, when you do go through a period of correction in markets, it's usually not just one down move. It's usually a down move, a bounce, a down move, a bounce, a down move, so on and so forth. So this has already been kind of abnormal, what we've seen in 2024, just this sharp drop that we had, and then almost instantaneous bounce back. So let me know what you think about all of this information down below in the comment section. Are you bullish? Are you bearish? Are you looking at, small caps and mid caps? Are you buying those areas of the markets, or are you going to stay more heavily focused in big tech? Let me know what you are doing and how you are positioning your portfolio down below in the comment section. In the meantime, if you made it to the end of this video, hit that like button and subscribe to the channel. It costs you absolutely nothing to do so. Maybe you'll stay more informed about what's going on in our markets, and maybe these videos will help you make more money. Again, none of this is financial advice, and I am subject to be wrong. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.